Hi traders, you're welcome back to the Forex Geek channel. Are you struggling to understand ICT concepts and how smart money moves the market? Well, you are not alone. Okay, many traders find ICT strategies confusing, but in this video, I'm breaking down everything that you need to know, right, in a way that is easy to understand and apply to your trading. So, we're just going to be covering key ICT concepts simplified, okay, including what ICT concepts are and why they matter, how to spot smart money movements using liquidity, order blocks, and market structure, and the best ways to integrate these concepts into your trading. So make sure to watch until the end because these concepts can change the way you trade the markets. And before we dive in, hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. Now let us get started. So what exactly are ICT concepts and why are so many traders talking about them? Now, ICT or inner circle trader refers to a trading methodology that focuses on how institutions, banks, and smart money operate in the financial markets. Now, unlike retail trading strategies that rely on indicators, ICT trading is based on market structure, liquidity, and price action. So the biggest advantage of using ICT concepts is that they help you understand why price moves the way it does. Instead of chasing random signals, you start anticipating moves based on smart money behavior. Now, if you've ever felt like the market is designed to trap retail traders, that is because it often is. And ICT concepts help you think like a professional and position yourself alongside big players instead of against them. Now, let us just go over the three most important ICT concepts that can help you level up your trading game. The first is liquidity, right? The fuel that moves the market. Now, liquidity is a major driving force in the market. Institutions and smart money look for areas where retail traders have placed their stop losses and pending orders. Now, these are known as liquidity pools. All right. Areas where retail traders must have already placed their stop losses and pending orders. Smart money pay attention to those levels. Institutions and smart money, they look for such areas. Those areas are important areas, right? Those areas are important areas. Okay. For example, if price is hovering near a recent swing high or low, it's likely that liquidity is resting there. Smart money often pushes price toward these areas before reversing. So how do you use this in trading? Now you have to identify liquidity zones where price is likely to target before making a move. Wait for price to sweep liquidity and show signs of reversal before entering a trade. Okay. Now let's quickly talk about order blocks, which are smart money footprints. Okay. Order blocks are areas where institutions place large orders, creating strong support or resistance zones. So these blocks often form before a major price move and can act as high probability entry points. So how do you use this in trading? You look for bullish order blocks in an uptrend. All right. When you have an uptrend, just look for bullish order blocks. All right. And then in a downtrend, you look for bearish order blocks. Okay. So in an uptrend, you should be looking for bullish order blocks. In a downtrend, you should be looking for bearish order blocks. Okay. Now use these zones as potential trade entries with tight risk management. Now let's talk about market structure, reading price action like a pro. Market structure is one of the most powerful ICT concepts because it helps you understand the current trend and potential reversals. Now, the basics of market structure are higher highs and higher lows form an uptrend. As you can see, what we have happening here, you can see that we have higher highs and higher lows. This is what we call an uptrend. All right. Then we have lower highs and lower lows. Right? Lower highs and lower lows form a downtrend. All right. So when price is making lower highs and lower lows, it forms a downtrend. Then we have break of structure. Okay, break of structure occurs when there is a potential trend change. Right? For example, we can see that we had this trend change from an uptrend to a downtrend. We had a break of structure because these higher highs and higher lows suddenly changed into lower highs and lower lows. Okay. Then we also have a change of character, right? That occurs, that shows early signs of reversal. When you start seeing early signs of a reversal, okay? Now, how do you use this in trading? You identify the current trend direction before placing a trade, and you wait for a confirmed break of structure before taking a reversal trade. So if you want to trade in the direction of the trend, just get confirmations in the direction of the trend. If you want to trade reversals, ensure you get a perfect, or rather, ensure you get a good break of structure signal, right, before you enter the reversal trades. Okay, mastering liquidity, order blocks, and market structure can help you predict market movements more accurately and avoid unnecessary losses. Now that you understand the core ICT concepts, how do you actually use them in your trading? The first step is to identify liquidity zones. Okay, look for areas where stop losses and pending orders might be resting. All right, just look for areas where stop losses and pending orders might be resting. Okay, areas where stop losses and pending orders might be resting. These are common areas where smart money targets price before making a move. Okay, then the second step is to watch for liquidity grabs. If price sweeps a key high or low and then quickly reverses, let's just see if we can find a good example. All right, okay, I think we have a good example around here. Remember, you should first of all identify areas where stop losses and pending orders could be, right? You can see that this is a significant zone. Then you watch out for liquidity grabs. You can see that in this case, you can see how price broke below this zone and swiftly went back up. So it is possible, it's actually possible that there was a liquidity grab, or the price dropped below the support and quickly rushed back up. So if you are the type of trader that quickly rushes to enter a breakout trade, thinking that this breakout was valid, then you would have been stopped out, or you'd have been in a loss, because eventually, can you see, eventually this was a significant uptrend, a really significant uptrend after this consolidation phase. Okay, so once you have identified these significant zones, you can find other blocks. Okay, check for institutional candles, all right, before a major price move. Just look out for institutional candles. If price returns to these levels, it could be a high probability trade entry. Then finally, analyze market structure. Okay, confirm whether price is in an uptrend. All right, confirm whether price is in an uptrend, a downtrend, or ranging market before making a decision. Combining all of these steps helps you trade with a smart money instead of against it. So even though ICT concepts are powerful, traders still make common mistakes. And here are a few to watch out for. The first is ignoring the higher time frame structure. Always check multiple time frames to confirm your setup. Okay, it is very important. And then do not force trades at order blocks. All right, do not force trades at order blocks. Okay, just because price reaches an order block does not mean that it will reverse immediately. Okay, so wait for confirmation. Always wait for confirmation. Okay, and do not trade against the overall trend. All right, do not trade against the overall trend. If you have a sell trend, do not trade. Do not be looking for buy opportunities in a sell trend. Okay, if you have a buy trend, do not be looking for sell opportunities in a buy trend. Okay, all right. Now, even if liquidity is grabbed, trading against the trend can be risky. Okay, so always align with market structure. By avoiding these mistakes, you will use ICT concepts more effectively and improve your trading success. All right, traders, that wraps up this breakdown of ICT concepts. If this video helped you understand smart money trading, make sure to smash that like button, subscribe to the channel, and turn on notifications so you don't miss future trading insights. Drop a comment below. Are you using ICT concepts in your trading? What is your biggest challenge when applying them? Let us discuss. Stay sharp, stay smart, and I'll see you in the next video.